Good morning, good afternoon, and good evening, everyone. And thank you for joining us for today's webinar titled, Do Private Equity GPs Deliver Value for Fees? I'm Joey Malagon, a Managing Director in Kroll's Alternative Asset Advisory Group. I've been with the firm for a little more than 20 years, and I'm part of our portfolio valuation practice, where we work with alternative asset fund managers and investors in valuing their illiquid investment portfolios. I'm very pleased to be joined today by my colleagues PJ Visio and George Pushner. PJ is a managing director in our alternative asset advisory practice based in New York, and he has over 35 years of valuation experience within the private equity channel, providing advice and analysis to general partners and their funds portfolio companies. George Pushner is a director within our alternative asset advisory practice and is also based in New York. George has a PhD in finance and demonstrated expertise in portfolio valuation for more than 19 years. Now, before we get into the presentation, I'd like to cover some brief housekeeping items. First, this webcast is being broadcast live. We suggest you enlarge your media player to full screen when viewing the presentation. We also encourage you to submit questions throughout the presentation. You can submit questions electronically through the webcast console Q&A widget. And if we don't have the chance to answer every question during the live session, we'll be sure to follow up with you directly after the presentation. Finally, a recording of today's webinar will be posted to our website over the next few days. During today's webinar, we're going to begin with a brief introduction to Kroll and our alternative asset advisory practice, and then we'll dive into the program, during which PJ and George will provide an overview of created value attribution, and then afterwards we'll address any questions that the audience has. So to begin with a brief overview, Kroll, as the leading independent provider of risk and financial advisory solutions, Kroll leverages unique insights, data, and technology to help clients stay ahead of complex demands. We have a global team of more than 6,500 professionals worldwide who continue the firm's nearly 100-year history of trusted expertise spanning risk, governance, transactions, and valuation. As I mentioned, PJ, George, and I are all part of Kroll's alternative asset advisory practice, where we provide comprehensive valuation solutions to fund managers and investors across the areas of valuation governance, execution, data management, and the design and implementation of best-in-class valuation processes. Okay, with the Kroll commercial now complete, I'm pleased to hand the floor over to PJ and George. PJ, please take it away.
Really trying to figure out, what is driving returns? What are the factors that are driving created value? Why? Why is attribution analysis performed? I would say it can be summed up in one word, and that is transparency. It provides a window for GPs to assess their own performance and hopefully allow them to better articulate their value proposition to investors. On the investor side, well, let's just say that returns will always be number one with investors, but how value is being created, the source of the returns, how that's being done has become a paramount. When it comes to things like sourcing, structuring, and executing deals, that's required just to get to the table. I mean, that is what we call in the States blocking and tackling, But the focus today for LPs is returns that are driven through building better businesses, through operational value add, strategic value add, or some combination thereof. And this is done through deep industry expertise and operating expertise. We tongue in cheek, we call this slide how not to attribute created value. I'm sure everybody here today recognizes this as the traditional value bridge. whereas created value, that is the value of the company, of the investment from that's created from entry to exit, is a function of three factors: change in EBITDA, change in multiple, change in net debt. Of course, the methodology is to change one variable at a time while holding the others constant. And there is a conventional wisdom that everybody, I'm sure, is aware of, and that is investors look for value that's created through increases in EBITDA, because those are assumed to represent improvements to the operations of the underlying portfolio company. Whereas, multiple expansion, and maybe that's discounted or even dismissed as a macro factor. And there are a couple problems with this. Number one, you can increase EBITDA through acquisitions. You can purchase EBITDA. That doesn't mean you're creating value. You're buying it. Okay, you're not creating it. And hopefully, the stage is being set for future value creation. So that's number one. Number two, EBITDA can go up and down with industry trends and cycles. So the increase in EBITDA could be related to secular factors. So to say, gee, we increased in EBITDA by 15%. That's nice. How'd the rest of the industry do? Maybe the industry averaged 20%. So there's benchmarking is important to really understand that. The other thing regarding multiples, George and I think between the two of us, I think we have somewhere between 5 and 6 decades of valuation experience, and we'd be the first ones to tell you that multiples can go up, they can go down for reasons good, bad, and neither, or neither. So without looking at detail, without looking at context, saying that a multiple expanded or contracted really has no particular meaning.
PJ, maybe a quick question here, if I may. Is the conventional wisdom still applied today? Just given the potential flaws that you highlighted, how common is it to see the traditional value bridge used by market practitioners today?
Okay, I would say particularly a number of GPs and then LPs as well, do something that's a little bit more robust from what George and I have seen over the years. But give you an example, a few years ago, before COVID, George and I did a presentation in front of about 150 LPs, and we did a survey ahead of time. And what we found is that in excess of 90%, of the LPs performed attribution analysis, and of those that do, a majority was relying solely on the traditional value bridge. And hopefully things have changed since then, but I think it's a very good bet that it's still being utilized out there.
Got it. Thanks.
Okay. So the fix is the framework that we here developed. We call it the Kroll CVA framework, formerly known as the Duff and Phelps CVA framework, and also known as the Visio-Pritchard model. What it does, it starts with the traditional value bridge. We thought that was a reasonable place to start. And what we do is we incorporate portfolio company level industry benchmarking. The second thing that it does is that it quantifies and segregates out the impacts of add-on acquisitions, sort of reset the initial parameters. Basically segregates out acquired EBITDA, the acquired multiple, if you will, so that you can look at real changes that are organic in nature. So basically what we've done is we've addressed the two major flaws that we identified. Okay, we want to emphasize here that it is not, it's not a black box. Okay, there's no differential equations, and more importantly, it's an open, non-proprietary framework. Okay, you don't have to hire Kroll to do this. And what it does is ultimately, instead of changing EBITDA, changing multiple, changing net debt, it attributes created value to 4 what we call fundamental sources. one is industry sector. You can think of that as hugging the benchmark, if you will, which is, it's sort of important because, there's, being able to identify where and when to invest is very important. Then there's beta, or we call capital markets, which is merely asset inflation and deflation as market rates of return go up and down. And that is clearly something out of the control of the general partner. Third is deleveraging, which we recognize as a very important source of returns in private equity. However, deleveraging does not address the question as to whether or not value has been created through building a better business. And the fourth category is alpha, or unique. And essentially that is organic value creation on an outperformance basis. Alpha basically indicates building a better business with better than average results. And, I would say with it, looking at analyses that go from entry to exit, that with the exception of the benchmark selection, the framework is essentially math.
So PJ, maybe one more question here. Thinking about the framework just in the context of the current environment, how do current market conditions impact the analysis? For example, the current interest rate environment.
That's a very good question. In today's environment, you have higher interest rates. Okay, that entails lower debt capacity, number one. Number two, with every debt payment that's made, okay, more of it's going to be going to interest expense and less to pay down a principal. So in this environment, deleveraging will be a diminished source of returns in private equity. So, and I think that underscores the importance of really focusing in on being able to drive returns to create value through building better businesses.
Thanks.
A little more background on the CVA framework. It's been well received in both the LP and academic communities, as evidenced by white papers that we've collaborated on with both INSEAD and ILPA. We have about a decade's worth of experience doing this. We have performed 93 comprehensive, that is entry to exit studies to date. That doesn't include any interim studies or high-level studies that we've also done as well. GP clients who've hired us, they span from emerging markets to middle market to large buyout. There's also anecdotal evidence that there are other GPs out there who have or are trying to adopt the framework upon LP request. We have a detailed CVA white paper, as well as a white paper series. The large white paper, it's available. All these white papers are available on our website, and I believe we'll be sending you or have sent you links as well. George and I are also working on the definitive CVA handbook, which hopefully will be published this year. And it is a step-by-step guide on how to do attribution analysis utilizing the framework that we're about to discuss.
So PJ, you and George have been doing this for about a decade. You commented on how this framework has been received among the LP and the academic communities. How about the GPs? Maybe if you could comment on how the framework was received by the GPs in the early days, and I'm wondering, has that perception evolved over time in the GP community?
Initially, a range of reactions to it. Some GPs, like you could see the light bulb go on over their heads. They became our early adopters, particularly since they were highly confident that they did well in terms of creating value. And others were like, this is great. This is a Cadillac or a Maserati. We do what we do internally might be a Chevy. But back then, and I think we're still kind of in it, I think we're in a pause, but we were in this environment of superabundant capital. And a number of GPs reacted by saying, okay, we get this, and why should we do this when investors are throwing checks at us? So I think that has certainly changed today. And I think that's in terms of other GPs being willing to do this with upon LP requests. I think we've seen some of that activity, in relatively recently. So I think that might be, a factor driving that. George, would you please take our audience through an overview of the framework?
Thank you, PJ. And please keep in mind that, as PJ noted, the purpose of doing this is to increase transparency. And so we want everyone, both LPs and GPs, to understand how this works. And this slide, it basically shows you how it works. We start at the top with industry convention. The next row we call primary deconstruction, and we break down EBITDA into a change in revenue and a change in margin. I think more importantly, we break down the multiple into a change in the cost of capital. That's the industry cost of capital, and that essentially breaks out the macro piece of the equation. And what's left we call growth profile. That's sort of the future part of the multiple. Lastly, we break out net debt into various components to really better isolate real deleveraging. The third step is we call the integration of performance benchmarking. So we look at the change in industry revenue or market size. After we pull that out, what's left is a change in market share. We do the same thing for margins, break out industry margins, and we have a company-specific margin that's left. And the same is done with industry growth profile, which again leaves an incremental piece. And keep in mind, for this step, we spend a lot of time here to identify the market. We essentially come up with a market composite of comparable companies. And we spend a lot of time weighting those companies based on geography and product and service relevance to really define the industry as well as we can. And essentially, this represents the opportunity cost to investors of investing in the subject company rather than the available benchmark or composite of other companies. Lastly, we pull out the non-organic or acquisitions. So there's acquired revenue from an acquisition, acquired margin, and acquired growth profile. Note that the latter two can be negative if you acquire a lower margin business or a lower growth business. And we also assume that the three pieces add up to the purchase price, assuming that the add-on is done at fair market value. And what's left then is the three alpha boxes at the bottom: revenue alpha, margin alpha, and growth profile alpha. And this essentially shows how the subject company has outperformed after accounting for everything above. It's the residual, the unique, again, outperformance on a organic basis. Okay, let me move on and show you some actual numbers. So this is loosely based on a real example here. And just to walk you through a little bit of how to interpret this tornado diagram, the first line is the change in market size. If this subject company had grown with the market, the value would have increased by 181 million. The next line is the revenue impact of add-ons. And so that increased value by 194 million. And the third line is the revenue alpha, or what's left on a revenue basis. And here that's very negative, reducing value by 613 million. So in this case, the company did not keep up with industry revenue growth or the revenue growth implied by the add-on acquisitions. Things get better, though, in terms of margins and growth profile. There, about 4 lines down, we see a very positive margin alpha of 674 million. And a few lines below that, we see a very positive growth profile alpha. Lastly, if we break out some of the balance sheet impacts, note that we have to pull out the acquisition debt, the cost of doing the add-ons. We also pull out ownership dilution from management incentive plans. And what's left is the deleveraging, which is a positive number here as well. So this often really tells a story and can be used by the GP to substantiate their story. And in fact, in this case, the story was that the company walked away from a lot of unprofitable customers. That's why their revenue alpha is very negative, but they more than made up with that by increasing their margins from getting rid of those customers, as well as from positioning the company better for future growth. We also then boil down all of these value drivers to the 4 fundamental sources that PJ noted before. So these are, again, deleveraging, unique or alpha, industry sector, and the capital markets or beta. And you can see there how the individual factors map to the 4 fundamental sources, which is very straightforward. And then jumping back to our example, you could see the results pretty clearly here. This was not a home run investment, and part of the reason for that was headwinds in terms of industry sector and capital markets, especially in terms of capital markets. So very negative impacts on value from the first 2 pieces. But looking at deleveraging and unique really preserved quite a bit of value in this environment and led to positive value creation overall.
Also, I just want to point out that in this case, there was a really significant negative capital markets impact, as George said, but that's unusual from what we've seen from the studies that we've done. The reason, and we'll show you some data later that shows that, overall data tends not to be a really big driver. But in this case, there was something in between the investment date and the analysis date was called the 2008 financial crisis. So that's what's really driving both capital markets and industry sector negative.
Thanks, PJ. And finally, we can aggregate this across investments very easily. So we can look at things on a fund level or across multiple funds or the last X investments or whatever makes the most sense here. It's all very additive. And when you look at things across a number of investments, you start to see very important trends about the ability of the GP to create value consistently. Note that not every investment will always have positive alpha, but we also note that there are examples of positive alpha where total value creation is negative, such as in the 3rd column for the investment in sports. Also various statistics, and this really can help the GP again to demonstrate their value add. Finally, we also want to note that there is a lot of flexibility in the framework. This can be used where there is data on revenue and margin impacts for specific initiatives or different products or customer mix. We can break out the value by those components. We can also look at things like the value impact of ESG initiatives, which is certainly getting a lot of attention. Finally, this is flexible across time periods. We can look at multiple periods. We can look at things before and after a certain event, maybe a management change, restructuring, major initiatives, et cetera. It can also be applied to unrealized investments and can also be done periodically to show impacts on value creation over time.
So, George, maybe a question here. You mentioned that the analysis can be applied to unrealized investments. Imagining that the assumed exit value would be a critical input to the analysis for an unrealized position. Just wondering, are there additional procedures that are typically undertaken to test or sanity check those assumed exit values under that sort of a scenario?
Yes, the one additional step is, since we don't have an exit as a market event with third parties, we need to do some diligence to have confidence in the valuation as of the analysis date. So this would typically be similar to the assurance that we provide to many clients. If we've already done that, or if the GP has another party doing that, and has demonstrated their valuation process well, that's easy to sign off on. But otherwise, we do need to do some diligence to make sure the value at the analysis date is meaningful and representative of fair value.
Got it. Thanks.
Now, this part of the presentation, what we'd like to do is share some of our observations that we've made based on our 93 studies to date. And by the way, I believe shortly we'll be starting studies numbers 94 through 97. Let's talk about our sample. The sample is biased. It is biased through both positive and negative selection. If you do this for somebody on a sample basis and they like what they see, they ask us to do more. If the first time we do this for somebody and they don't like the results, they'll say they'll get back to us. And we generally do not hold our breath in that case. So it is obviously, so it's biased positive, okay? But however, we thought that looking at this might provide some insight into value creation in certain private equity investments, and perhaps talk to the GP group as a whole. It's pretty diverse in terms of sizes of industries. And periods, regions, geographies, it's a nice mixed bag. It's a pretty broad sample.
Okay, and so we're going to start off with just some basic statistics about alpha value creation as well as overall value creation. We see that about 75 of the 93 had overall alpha. A few more of those, about 84 of the 93 had positive total value creation, and the remaining 9 saw a reduction value. And so, of course, as mentioned before, there are examples of those where there is positive alpha despite an overall reduction, and in the other direction, sometimes there is negative. Certainly, there are 18 examples of negative alpha creation despite positive total value creation. We do find that almost 99% of the investments did show some type of positive alpha. 24 or almost 25% of the investments showed alpha across all 3 measures: growth, margin improvement, and growth profile. And 44 had it across 2 components, and 25 had it across just a single component.
So this is an interesting slide. What we've done here is shown, we've aggregated the results of all 93 studies and looked at the resulting four-source attribution, if you will, just adding everything up. As you can see here, the 2 big drivers are industry and alpha, with alpha being a little bit bigger. Deleveraging was relatively small. We did have some clients in here who really didn't use a whole lot of leverage compared to some other GPs. And as you could see, as I alluded to earlier, beta is relatively a small contributor to value creation, or sometimes destruction. So that would be probably like a net effect, because obviously sometimes it goes up, sometimes it goes down. Now the graph on the lower left, that I find very, very interesting. We've taken the alpha and we've broken that out among revenue alpha and margin alpha and growth profile alpha. And what we find here is change in revenue alpha is negative. Now, that doesn't mean that revenue is declining. It means that overall, the increase in revenue, fell below that of the respective industries. However, though, you've got very big positive results for both margin alpha, change in margin alpha, and change in growth profile alpha. I think what this tells us is that at least overall, the GPs in our sample, have created value through not so much building bigger businesses, but by building better businesses.
So this slide may be a surprise to many people. We understand that returns are paramount, and we wanted to see how well those returns were correlated both with EBITDA and with our measure of alpha. And the answer is there's very little correlation with either measure. EBITDA is not the real driver of IRRs, and alpha is also not typically correlated with returns. The basic reason for this is that you can have very high alpha with high or low returns. And so the returns on themselves do not necessarily indicate unique or alpha value creation. And in fact, that's the reason you need to do more to go beyond returns, especially in markets where everyone is showing, or almost everyone is showing, strong returns. This might go away certainly with a larger sample where we were able to control for vintage and sector. But certainly it's a very interesting result that suggests the need to look beyond returns. And a related observation is the topic of value preservation and what happens when we see industry headwinds. And this, as we noted earlier, can often spotlight alpha value creation. It's particularly when things are difficult that sometimes the largest alpha is created. Keeping the company ahead of the industry and the macro forces to show outperformance and hopefully positive returns despite a negative market.
When George and I do presentations, this is the slide that we want people to really remember and take back with them. What this shows is it's a regression analysis that George has done, looking at alpha versus value increases based upon EBITDA without any modification. That is EBITDA as per the traditional value bridge. So the question is, does change in EBITDA, value created through EBITDA, does that correlate with alpha? And alpha, again, is organic value creation on an outperformance basis. R squared here is 10%, which means that there is no to little correlation at all. And when we've looked at these deals, one by one. And if you want to guess, oh yeah, positive EBITDA change, positive alpha, you'd be off by 50%. Half the time it's misleading. So, so utilizing the traditional value bridge, I mean, it's coin flipping territory. We like to, tongue in cheek say that, if you flip a coin, it's cheaper and it's faster than actually doing an analysis utilizing the traditional value bridge. Okay, we're wrapping this up with how we can assist. Okay, first of all, we'll be continuing thought leadership on the subject through our CVA white paper series. As I mentioned before, all these are downloadable from our website, and these are absolutely free. We'll provide guidance to the CVA handbook forthcoming this year. We can also provide in-house training, also provide advice and assistance if a party wants to do this, adopt the framework and do attribution analysis themselves. We're happy to stand by and provide advice and assistance, okay? And of course, we can also provide independent analysis as well. I think this wraps up the program, and I believe it's time for questions and answers.
Great. Thanks so much, PJ and George. And yes, let's move into Q&A. And as a reminder for our audience, you can submit questions electronically through the webcast console. If you look to the Q&A section of the screen, you can input those questions there. We do have a number of questions that have already come into the queue. I'll start with a question around portfolio companies that are highly acquisitive. The question is, how might the framework look when applied to portfolio companies that have an M&A roll-up strategy? Are there any particular nuances or considerations when dealing with those types of strategies?
I'll jump in. It's really very straightforward. It's a basic part of our framework to pull out the add-on acquisitions. This, sometimes is a bit of a data burden for the GP if it goes back to older deals, but all we really need are the revenue, the LTM revenue and EBITDA at the time of the acquisition for the target, as well as the value of the platform company at the same time. And so, it's really part of the process and very straightforward. It can be challenging, if the strategy is doing a bunch of small mom and pop roll-ups, that creates a problem. But for the more typical large roll-up strategy, it's very straightforward.
Yeah, I believe we've had one situation where the roll-up strategy was actually acquiring mom and pops, okay? Fortunately, the companies that comprise the benchmark were also basically growing through, in large part, by acquiring moms and pops. So in this case, since really the data, I would say, gathering in those cases was impractical, because the companies comprising the benchmark were doing the same thing, we sort of all treated it as a quote-unquote organic growth. And of course, we've well documented that methodology in that case.
Great, thank you for that. Another question around entry versus exit analysis. And the question is, would you say that GPs might be shooting themselves in the foot if at entry they're considering or focused on a forward-looking metric, so let's say forward EBITDA, to inform their entry multiple at acquisition? When the analysis then ultimately gets performed around CVA, does that essentially eat into any sort of positive alpha value creation around EBITDA that they would get credit for, right? In that forward entry multiple might have taken into account some of that expected growth from entry on forward.
Yeah, I'll take this one. What I would say is, the methodology utilizes the LTM, of the historical EBITDA, because that's where you start with, right? That is your entry EBITDA. The pricing, yeah, they do. It's always valuation. Pricing is always a forward-looking exercise, okay? But that would be reflected in the multiple, in the growth profile, okay, relative to the entry EBITDA. So as time goes on, so it would be higher as the LTM multiple, if you will, would be higher than the future EBIT, forward multiple, because that's based on a grown EBITDA. So yeah, again, we would recommend starting with the actual exit EBITDA and the actual multiple at entry.
Great, thanks, PJ. We've received actually a couple of questions just in terms of comparing and contrasting other attribution analyses, a direct alpha approach, for example, and just a question of how you guys think this approach compares or contrasts with or complements other types of analysis, for example, NPV-based research.
George, as you being the PME specialist, I'll let you address this one.
Yeah, we think this is very complementary to other metrics and analysis. Everything from IRRs and MOICs to public market equivalent analysis, and this really can be thought of as a bespoke, sort of customized public market equivalent, where the market equivalent is, rather than a broad benchmark, it's a very carefully estimated market composite of peer companies, and then we add on the add-on acquisitions to pull out organic growth. But essentially, the PME is an important step forward and should give complementary and results in a similar direction. If you have alpha, you're probably showing a very positive PME, and perhaps the other way around. And then in terms of other more sort of elaborate estimations, that there's not one answer here. We think our framework has the advantage of being very transparent and very straightforward. But we think LPs appreciate a lot of different analytical tools, and so we think certainly don't rely just on the industry convention. We think this is very complementary and certainly a big improvement on that.
Yeah, and one thing, advantage of the CVA framework is that the other analytics pretty much address like how much. The CVA framework here also addresses how the value was created.
Great. Thanks again, PJ and George. Seeing that we're right up on time, we're going to go ahead and close out today's program. For those questions we weren't able to reach during the live session, we'll be, again, sure to follow up directly with each of you to address and discuss. But PJ and George, thank you both again, and thanks to all of our webinar participants for joining us today and for the thoughtful questions. To the extent that you have additional questions, or if you're interested in exploring CVA further, we'll be sharing contact information for both PJ and George within an email that will be shared with participants in the coming days. That email will also include a link to the replay of this session, so keep a lookout for that. But we will go ahead and conclude now. Once again, thank you for participating today. Hope everyone has a great remainder of the day ahead. Thanks.